Gravita India is the nation's largest organized recycling company. To understand how they've reached that scale, we're going to run a metric-by-metric audit of their underlying compounding engine. The operation begins here. The core loop consists of sourcing used lead-acid batteries, industrial battery waste, and metal scrap. Gravita processes these raw inputs into refined lead, specific alloys, and plastics, which are then sold directly back to original equipment manufacturers. But processing capacity is only half the equation. The primary constraint in the global recycling industry is supply. Profitability stalls when plants are forced into idling empty because they cannot consistently source enough scrap to maintain high-capacity utilization. In the industrial recycling sector, owning a sprawling manufacturing footprint matters less than controlling the logistical procurement network that feeds it. Gravita manages this bottleneck through sheer density. They operate over 1,900 distinct touchpoints and 33 owned scrapyards, distributed primarily across India, Africa, and the Middle East, funneling materials into 13 central processing plants. This deep geographic diversification prevents reliance on any single regional supply chain. If local scrap availability tightens in one market, the global network steps in to ensure raw material security and keep overall plant utilization high. That legacy physical network is now being insulated by government policy, specifically India's Battery Waste Management Rules of 2022 and new extended producer responsibility mandates. These regulations impose strict collection and processing standards on battery manufacturers. The resulting compliance costs are filtering out smaller, unorganized operators who lack the capital to meet the requirements. OEMs are now legally obligated to source from compliant processors. By combining an extensive legacy physical network with these new governmental compliance mandates, Gravita captures the market share previously held by the unorganized sector. Heavy industrial businesses constantly balance two competing financial metrics: the absolute profitability of their EBITDA margins and the capital efficiency of their return on capital employed, or ROCE. Gravita solves this tension by splitting its operations into a four-tier architecture. At the top of the profit scale is their overseas recycling operation. This segment yields the highest absolute margins, generating roughly 28,000 rupees of EBITDA per ton. The middle tiers consist of imported and domestic institutional scrap processed in India. These segments offer mid-tier profitability, yielding between 12,000 and 19,000 rupees per ton. The base of the pyramid relies on tolling arrangements with major battery OEMs. While this generates the lowest margin at just 7,000 to 8,000 rupees per ton, it commands an exceptional ROCE of greater than 25%. Tolling achieves this return because the battery manufacturers supply the actual scrap themselves. Since Gravita doesn't purchase the raw materials, the working capital requirement for this specific segment drops close to zero. The company uses overseas operations to generate heavy cash flow and relies on the tolling model to drive high capital velocity. We can track exactly how this blended architecture translates into financial outcomes by looking at the projected growth estimates. This document outlines analyst coverage on Gravita's forward metrics. Between FY24 and FY27, they project a revenue CAGR of 26% and an adjusted PAT CAGR of 31%. To hit these numbers, plant utilization is critical. Because of their advanced procurement network, new facilities, like the recently commissioned 80-kiloton capacity at Mundra, are able to rapidly hit 60 to 70% utilization immediately upon coming online. Looking further down the same report, we can check the return ratios. In FY24, the company posted a 24.8% return on equity and an approximate 30% return on capital employed, with projections maintaining those levels for FY27. They maintain high asset turnover by executing expansions as brownfield projects and building new facilities through their own in-house turnkey division. By building their own plants, they keep capital costs structurally lower than competitors. By pairing high plant utilization with capital-light capacity additions, Gravita extracts aggressive compounding returns from heavy industrial assets. Generating high margins on an income statement means nothing if the business cannot convert those on-paper profits into actual cash. We verify this by tracing the working capital cycle. We have to look at the gap between how long inventory sits in the yard and how quickly debtor days translate into cash receipts. The tolling model structurally tightens this cycle. Because the OEMs own the material, Gravita avoids tying up cash in inventory, resulting in strong cash flow from operations that legitimately backs their reported profit after tax. We also need to check the balance sheet leverage. The company's net debt to equity ratio sits at a minimal 0.2, paired with a high interest coverage ratio. Rather than taking on heavy debt, the company funds its capacity expansion almost entirely through its own internal accruals, keeping balance sheet risk isolated. As of today, traditional lead recycling is the cash cow, responsible for roughly 88% of Gravitas sales in FY24. The management strategy is to redirect that steady cash flow to build asset-light capacities in new recycling verticals, specifically lithium-ion, paper, and steel, without needing to dilute existing equity. The proof point for this transition is already online, marked by the recent launch of a 6-kiloton lithium-ion battery recycling plant in Mundra. This positions the company directly in the path of two macro trends: the accelerating adoption of electric vehicles in India and the massive incoming wave of degraded modules from battery energy storage systems. Gravita operates as an organically funded, deeply embedded node in the incoming global EV supply chain. To finalize the analysis, we have to run a negative constraint check against 5 specific accounting and governance flags. First, earnings quality and inventory growth. Operating cash flow matches PAT, and high plant utilization ensures inventory does not pile up and outpace sales. Both clear. The 0.2 debt-to-equity ratio clears the leverage test. However, promoter pledging remains a dynamic metric. Serious investors must track pledging continuously to ensure the promoter shares remain unencumbered. Finally, equity dilution. The shareholding pattern is highly stable, with the promoters holding a comfortable 63.4% of the company. Gravita India's true value lies in its deeply integrated sourcing network, its perfectly balanced 4-tier margin model, and its regulatory tailwinds, making it a highly resilient compounding engine for the circular economy.